I wanted to get in front of you today because we had a program that some realtors were using. It was called VIP Community, Cox VIP Rewards. That site is going dark as of October 31st. Okay? If you had someone that you guys had you were closing on a house, you would put that information in, and some of you guys have prepaid cards, and then what went in this month, if we were able to sell it next month, you got a $25 commission on it from us. We're keeping the program for the East, okay? The website you guys were using was for the country, so you guys weren't the only ones using it. So for the East to keep it running, because Cox is scrapping that program, we had to rebuild the site. So it's a little bit different. So I don't have, my VPN's not strong enough in here to stay on it. So I will ask for all your business cards, like as you guys are walking out, if you could give it to me, and I will send you this website and the directions on how to do it. If most of you guys still have your prepaid card and it hasn't expired, we're still using the same company to refill it. So if we have your information, that's fantastic. You will have to restart it in this one, that you've never used this program, this and that. So I will be the face. Some of you guys have dealt with Rhonda in the past. Rhonda, she's the one who was keeping it. Now I have to rebuild it. Because she went to business services, and then I think she got a position outside the company with another one. It's called Cox Partner Rewards, just like you guys will get rewarded for the lead if we can close it. And it's a $25 spit for the lead that we close. And then at the end of the month, it will get loaded. At the end of the year, if it's more than $500 that you make, because we have one guy that makes like $2,500 or more off of us every year, you will be 1099 from the company. But to go forward, basically that's what it's going to look like when you log in. It's going to say, Cox, welcome to the Cox Referral Reward Program. I didn't put all of it, but it's going to say, if you put that you've never used it, your first time you will put no, you've never used it. It will ask you for all of your information, first name, last name. Where do we send the card? If you have a card, we're not sending you one, but we'll still have it just so we can reflect it with our records, because we do have a lot of you guys still on record. And then here, it's like new registration. It's just gonna ask you all of that. You gotta pick a region. So if your house that is sold is in Rhode Island, you'll click Rhode Island. If it's in Connecticut, because we do service like 6 towns in Connecticut, so you'll put Connecticut, so that we know where the lead is coming from. So we can make sure the right call center is calling these leads. So in the past, you were getting people calling from out-of-state phone numbers to these clients. They have a 30% close rate. So 30% of your leads were only getting closed. Where with us, we're going to be 80 to 90% close rate. So that also helps you with more income on that, because we're here locally. So our team is not only, they're on the calls, like they're available, from like 7 a.m. to 7 p.m., but we can be boots on the ground. So if they're not answering our call, because sometimes they're like, who's that? It's probably spam. We have collateral, we have letters, we have badges, and we'll just leave them like, welcome, congratulations on your new home, or even if someone who lives there has Cox services, you can get that information and put it in the lead, right? And we can contact them, because now they got to move out, right? They got to bring their services somewhere. You can just say in the notes, moving out, new person moving in, then send the second lead. So it doesn't just need to be the person who's buying the house. It could be the person who's selling the house. Double dip there. I don't know if you guys are aware of that. Okay, so, and then that's it. And then once you send it, that's what you'll see. It'll say, thank you for sending the lead. The leads will then come to me, and I will submit them into the round robin, because I have to make sure that it's, there's nothing wrong with I want to make sure there's nothing wrong with the address, that we haven't locked the account out or anything like that before I send it. So this is new. That site is up and running. It will probably change a couple of times while you're using it, like different screens and all of that, just because we are in the process of rebuilding it. Right now, the VIP site is still working, but it will come to an end at the end of this month. So I wanted to get in front of it. Any questions on this lead program that we have? All right, So if I get your business cards, I can send you guys the link and the directions. If you don't have a card, a prepaid card already, that's fine. Once you go into the system, you can even just get it, all your information in there, and then just put test on like the referral information, just so that we can submit your stuff to get a card. Okay? And I will be around. I'll be around at the end of your meeting if you guys have any questions or have anything more about the referrals. Okay?
Now we'll move on to our presentation, 1031 Exchanges by Joseph Barbara Ackaway. You're going to present for us. Yeah. Thank you very much.
Thanks.
Thank you.
All right. Thank you all for having us. It's nice to be here. We love to speak to realtors about 1031 exchanges, get an understanding to everybody. It's a topic that there's a lot of kind of mystique out there about, where people have misunderstandings about, that we run into a lot, that we like to just set straight and make sure that this becomes a tool for all of you as realtors to recognize opportunities where it can help your clients, help yourself, help your firm. Quick little background, I'm Joe Ackaway, this is my mom Barbara. We started our company, RI 1031 Exchange, about 7-8 years ago now.
We're going on 8.
Going on 8. And it is all we do. We're a true specialist in only doing one thing, and that kind of allows us to do it as good as possible. And our firm is a qualified intermediary for exchanges. So we work with all sorts of real estate professionals on sales and purchases. What 1031 refers to is the section of the tax code that outlines the procedures and requirements to carry these out, and it allows someone who's selling investment property to defer the taxes they would normally owe on that sale, so long as they're reinvesting the proceeds into more investment property. So today we'll get into different strategies that people use with 1031s to get the most of it. We'll go through the basic procedures, what our role is in all of this, and how it can really benefit realtors specifically. So typically, if you're selling an investment property, you would owe capital gains and depreciation recapture. Do you want to get into those layers?
All right, so without a 1031 exchange, if you're selling real estate that's not your personal principal residence, you would generally owe tax on that. If it is investment property, there's 2 layers of tax. The first layer of tax is a depreciation recapture. So basically, when you own investment real estate, you've been depreciating it over the life, which is great during those years because it's a nice write-off on your tax return. But when you sell that property, there's something called depreciation recapture. And what that is any gain up to the extent of the depreciation you've taken over those years is taxed at a flat, federally 25%, and then there would be the state tax on top of that, which in Rhode Island it would be an additional 6%. If your income is high enough, you'd also be subject to the net investment tax federally, which is an additional 3.8%. So you're looking at a lot of tax on the depreciation that you've benefited from over the years. And then any gain in addition to the depreciation recapture is your capital gain, which would be at the rates, everybody knows, 15% or 20%, depending on your income. And then the state tax would be on top of that. So with a 1031 exchange, and Joe will get into the details on how you can qualify for that, but with a 1031 exchange, you would be deferring all of that. You could defer all of that tax and therefore have more buying power on the property that you're going to be buying.
Yeah, and we keep using that term deferral, so it's not just an elimination of the tax. Your tax obligation rolls into the replacement property, and if you subsequently sell that, the tax would be owed at that time. But I will get into some more complicated end game strategies that can lead to avoiding the tax more entirely than just the deferral.
I just want to say one thing.
Sure.
As Joe said, you know, it's a deferral. When you sell that property that you've acquired in the exchange, you'd be looking at paying the tax, but you are able to do continual 1031 exchanges. So you could exchange into one property, you know, 2, 3, 4 years later, you want to sell it, you can exchange into another property and keep that deferral going.
Yeah, we have a lot of clients that we've seen doing that, and it becomes all the more valuable when you've done a couple of exchanges to keep that kicking the can down the road, really, because it just becomes more and more significant the more exchanges you've done. So, talking about the layers of tax and all that, you know, it sounds very complicated, and we like to reiterate that we take on all that complexity, and what I really want to drive home is identifying opportunities for these so you guys can know when to bring up the question that kind of gets them thinking about what they're doing. And a lot of people just don't know what a 1031 is at all. So to get that level of familiarity, to know when to have them give us a call, can go a very long way. Just last week, actually, I had a former client who's also a realtor call me saying that he was talking to one of his client and friends who had a closing the next day, and it was a perfect situation. They're selling a 3-family, they've held for rental, they're buying a duplex with the proceeds 2 weeks from now, and just making that connection in the call, that client is going to be deferring $100,000 in would-be taxes. That without making that simple connection, they would have taken the hit. So the idea of these is, if you're staying in that same ongoing investment, it's looked at as an unfair taxation to hit you at the selling point. That's kind of the rationale behind it. We hate the misconception out there that this is a loophole. It's absolutely not. It's been in the tax code for 101 years now. And it has the intent of promoting domestic reinvestment and just the economic benefits of keeping more liquidity, especially in the commercial market. People aren't not selling because of the tax. Instead, they're encouraged to, you know, carry out the transactions, knowing they have this tool to not be hit with that major tax consequence. Another misconception, these are also referred to as like-kind exchanges, and that had to do with, you know, the property you sell had to be of like kind to the property you buy. And a lot of people think that that means if I sold a residential 2-family, I have to buy a residential 2-family. That's not the case at all. And it's very generously broad within real estate. Any investment real estate qualifies as like kind to other investment real estate. That term is actually a bit redundant now because 1031s used to be used for more than just real estate. You could use it for fleets of vehicles, artwork, collectible automobiles, things like that, where the like-kind strictness was a lot greater and specific. So if I sold, you know, a bulldozer, I had to buy a bulldozer, not a wrecking ball, you know. In the original tax code, it actually refers to selling cattle and buying cattle, and it had to be the same gender to be like-kind. So, but for us in the real estate world, you can sell raw land and use those proceeds to buy a residential rental. You can sell a commercial property, buy a residential, vice versa. All sorts of things like that, as long as it's real estate that you're on title to. We have people exchanging docks, cell towers, a lot of interesting, unique things. As long as it's not your personal residence, that's really what allows it to qualify.
Can I
Yes.
ask a question? It does have to be equal or lesser or greater value?
Greater for a full deferral.
Greater. Okay.
Yeah, that's a good question. So one of the requirements for a full tax deferral is that they look to you to reinvest equal to or more than your sales price. A lot of people think, oh, I sold for 300, I'm walking with 100K, as long as I put that 100 into something, it's tax deferred. But you do have to reinvest at that $300,000 level, and you can match debt on it to make that work, but you can't exchange down in value. Yes?
If it were down in value, is there like a lesser percentage?
Yes. So that gets into what is a partial exchange, and you can do them. It doesn't make the exchange fail, and we see a lot of them. It's not uncommon. And just like you said, if I sold for $350, regardless of the debt on it, and I reinvest at only $300, I'd be on the hook for tax on the $50,000 difference.
Okay.
Yes.
Are there allowable deductions like commission, closing costs?
Yes, there are. Wonderful question. So we say you need to reinvest the sales price as adjusted. That is adjusted by just about all of your closing costs, commissions included. So
Right, all the transactional expenses that you ordinarily see on your closing statement that relate to the sale, as opposed to the items that relate to the operation of the real estate. So what I mean by that is your commissions, your transfer tax, your attorney fees, those would all be an adjustment to the amount we're looking at, but such things as the real estate tax adjustments and rent adjustments, those types of things aren't considered an allowable 1031 expense. So what we typically do once a client closes on their sale is we do an analysis of their sale price as adjusted, so we can tell them the exact dollar amount that they need to reinvest in order to have a fully tax deferred exchange. So, and importantly, the mortgage is not included in that adjustment, so it would really only be the transactional expenses.
And then, yeah, any questions that come up along the way, please do ask. We like that for the flow of things.
I wanted to throw one more thing in.
Go ahead.
It's nice to be his mom because I can just take the stage whenever I want. As far as the like kind, it can also you can also reinvest in any state. It doesn't have to be Rhode Island to Rhode Island. It can be. We're seeing a lot of Rhode Island to Florida to Texas, New Hampshire. A lot of the tax-free states. Yeah.
So one other question, so if I sell one property and take that money, can I invest in two properties?
You sure can.
Okay,
You can also do the opposite. Sell two, reinvest into one mutually.
okay.
Or more than one. Yes?
If you inherit an investment property and that new person has it now, that tax implication follows that?
That's a great question.
Well, we often will bring the CPA in on the initial consultation, because when you inherit property, you have a step up in basis in that property. So you're going into that property with whatever the fair market value on the date of death was. So if you inherit the property and sell it shortly thereafter, you would have no tax.
Even though for like say 20 years that person that had it defer, and then he dies and then the new person.
Then, the new person inherits with a step up in basis on the fair market value at the date of death.
And that's one of the two end game strategies I was alluding to earlier. If you work it into your estate planning and plan to gift or pass away and have the heirs inherit property you've been exchanging into, we call that the swap till you drop strategy, and it's
Calls it.
I call it that.
That makes sense.
So you have to die to make it work, but got to plan for that anyway.
So it is a good long-term plan.
Is that the same thing as gifting?
It's not, no. When you gift property, the person who's receiving the gift takes on the donor's adjusted basis. So if you've been 1031ing property, and let's say your basis is very low, and you gift it, the person receiving the gift now has that low basis. So it's treated quite differently, yeah.
So the obvious benefits, the tax saving for your clients, and as a realtor, if you have a client doing an exchange, typically you'll be seeing 2 commissions within a time bounds, because these exchanges I'll get into have very strict time frames that have to be adhered to. So typically you'd be seeing 2 closings within 6 months, and that purchase is going to be at a higher sales price with the 1031 rules, and they're you know, if they're saving 80,000, they're using all of that on the purchase end. So you'll see higher commissions, and you can, like I mentioned, be the one to enlighten them on these rules of this option for them if they're in a situation. So one of the most important things I like to encourage is if you have anyone selling something they've held for rental, any multifamily, anything they're not living in, ask the question, what are your plans for the proceeds? If like, I don't know, might look for something with it, say, well, you better know Barbara and Joe.
A question in regard to that, you said not living in it.
Yeah.
However, if it is a vacation home,
Mhm.
is there a limit as to how much time they've spent in it?
Yes, there is.
Okay.
So the rules for that, the rules for personal use on a property to still qualify, you can use the property for the greater of 14 days or 10% of the amount of days it's been rented out for, which is pretty strict. That's not a ton of time. So a lot of second homes wouldn't count if you summer there, but if it's something you know, primarily Airbnb, and then take a weekend or two here and there, that could absolutely qualify.
How do you document that?
You really don't.
Well, let me clarify.
I can tell you the rules.
When you file your tax return, on the Schedule E, it asks how many days it was rented. So it's self-reporting, you know, but,
So when it's vacant, is that considered your time?
No.
But,
no, it's not.
Yeah. And also if you're at the property, you know, doing repairs or cleaning after tenants, that doesn't count against you for personal use.
Yeah.
And if after hours you bring your beach towel. Just kidding, of course. Yes.
After that 180 days, I heard that you can, if you don't find a replacement house, that you can somehow put that money into like a pool of like, I don't know.
No,
She's
I might-
an opportunity zone.
oh,
Yeah. I think you're talking about an opportunity zone, maybe,
or maybe DST stuff.
and not if the 180 days.
No.
I guess it's like putting your money into like something else with a whole bunch of different investors.
Yeah,
Okay.
well, there's two things you might be alluding to. One of them, if your 180 days has expired, now your 1031 exchange has failed, and we return your funds to you. You would, however, still be able to invest in an opportunity zone, which an opportunity zone, there's several in Rhode Island. They're federally defined, you know, what's an opportunity zone, and you are able to invest your proceeds into that type of fund, which is outside of our area altogether, but I'm familiar with them somewhat. And those would allow you to have tax defer, well, it's tax deferred, I believe, if you hold it for at least 5 years, and then it's a declining balance on how much tax you'd have to pay if you own it up to 10 years, because it's the federal government encouraging you to invest in depressed areas. So if your exchange fails, you know, you may still qualify for an opportunity zone if you care to invest in one of those depressed areas. And then,
Yeah, the fact that you said pooling money, that made me think of DSTs, Delaware Statutory Trusts.
Yes.
So that wouldn't be the case after 180, but if, well, the timeframes, just to back up a little bit, you have 45 days from the date of the closing on your sale to identify replacement property, and that is the pressing timeframe. The other being 180 to close on something you've identified. So it's hugely important that people know their plans going into an exchange. They're either under contract for the buy in advance, or know their area very well, they're looking at it and are ready to, you know, be aggressive getting offers out.
So 180 on top of the 45?
Concurrent, so they both run from the date of closing.
Okay.
Yeah, the closing date is day 0 of the exchange, and then the clock starts to identify, which is listing up to 3 properties with us.
More specific question, if, like for example, right now, a commercial building, there's barely anything out there to purchase above or beyond what this particular commercial building's worth. So holding the paper for a while, how does that affect a 1031 after, like, holding the paper for 5 years and then doing the 1031 because they pay it off?
So-
That's like hyper specific.
so you're saying you're gonna do seller financing, so you're
Correct.
selling, you're gonna, That doesn't work well with an exchange because we wouldn't have the money available to invest in the replacement property.
Right, but after the 5 years of holding the paper, then
Okay.
the bulk,
Yeah, that's what, no, that wouldn't work for an exchange.
Because the closing occurs on the front end,
Yeah, it goes
regardless
with the
of when it's
closing
paid
date.
off or whatever.
It's, basically, it's when you transfer a title.
Yeah.
That's when your exchange period would begin.
Okay.
But, you know, as an aside, when they do hold paper, they are paying tax at a graduated, well, a
Yeah.
slower rate, so that may benefit them as well. Because with an installment sale, you pay tax as you receive the payments,
Right.
so.
Yes,
Just curious, does this also apply to mixed-use properties?
it does.
And then on top of that, are there restrictions as far as if it were residential, are there restrictions if, landlord could accept Section 8 or anything to that nature as far as
No,
rents or anything?
no, that doesn't interplay with it. Back to your DST question. So that is a Delaware statutory trust, which is a special type of reinvestment that's very popular in the 1031 world, which is, like you said, you get fractional ownership of a larger real estate project. It operates a lot like a REIT, but REITs don't qualify for 1031 because you're investing in a trust, not the real estate itself, but the Delaware statutory trust was blessed by IRS to qualify. So it's a extremely passive investment, which is the main draw. The main drawback is that you have no control of when those are sold off. So basically they operate for 3 to 8 years roughly, and then they sell the project off, you get your capital back, and you've been receiving basically rent checks along the way. But those are, like you're kind of saying, if you don't find anything, it would be by day 45, not 180, but you can opt to go the DST route as kind of a fallback or plan B, where you don't want to pay the tax no matter what, so you get connected with a broker for those. And those are complicated, and we only know so much about the ins and outs of them, but that is a route that we see clients go. So the partial exchanges we talked about, if you're either buying for less, it can also be a partial if you live in a multifamily, or your client lives in a multifamily where you're selling a 3-family, which you lived in 1 unit of. 2/3 of those proceeds can go into the exchange, and the third that you lived in, you would get the 121 exclusion on if you lived there for 2 of 5 years. So we see people combining those two routes to not pay Uncle Sam on all that. Yes?
Not to be killjoy.
Uh-oh.
But suppose something happens.
What
and
kind
you
of something?
guys-
Oh no?
Something's
You know.
happening to us?
Yeah, like
Oh,
your
that's-
company goes belly up.
We don't plan to do that.
I know, nobody plans to do that when they have a business,
No.
but like, what happens to the funds?
Well, can I?
Sure.
Okay, so, we have banking relationships with a couple of the banks. What we need to provide for them is a copy of our exchange agreement that sets forth the transaction and the client's identification and social security number. So when the accounts are set up, it would be set up as RI 1031 exchange qualified intermediary for, John Smith. So the bank knows and needs to know who the owner of the funds is. So if as you say, something should happen to us, that the bank,
Knows who it
the
belongs
bank
to.
is aware of who the owner of the funds is.
Yeah, part of the 1031 process, as intermediary, we have to hold the sales proceeds during the exchange period for it to qualify. So a lot of what we do, we interface with the attorneys on both ends of the transaction. We have to have certain 1031 language on the settlement statement showing net proceeds going to intermediary, and they fund us with what would typically be the bottom line cash due to seller.
Maybe you should just go through the process.
Yeah, a couple of quick smaller rules I just want to mention. The same tax-paying entity that does the selling needs to do the buying. So if you owned property in your name alone, the replacement property needs to be in that same way. You can't, buy it with a spouse and have all of that qualify. If you own property in an LLC, that same LLC has to do the buying as did the selling. The only caveat there is if it's a single member disregarded LLC, that's looked at as one and the same as an individual. So you don't have to worry too much about that, but that is one option of flexibility. All right.
Can you claim somebody on after the purchase?
Yes, you can. There's some.
We do run into that all the time, by the way. You know, people want to add a spouse or dump a spouse or, you know, or their lawyer's saying, no, you need to buy this new property in an LLC. And, you know, as long as it's, like Joe said, as long as it's a single member disregarded LLC, and say, if Joe and I were selling property, we couldn't create a partnership LLC to buy property because it's no longer a single member disregarded LLC. But if it's one person selling, that one person can create that type of LLC to buy the replacement property.
Yes.
Can you explain more about the single member disregarded? What is that?
Yeah, what that is, when you create an LLC, you have the option to select the type of tax treatment it gets. And if it's just one member in that LLC and they don't choose to have corporate taxation, then that's what's considered disregarded. And what it means is that LLC, everything on that LLC flows right through to your individual tax return. So if you created that type of LLC to own real estate, you're filing a Schedule E as you ordinarily would. But if it's more than one member, they don't have a choice to be taxed as disregarded because it's more than one member and it's automatically going to be a partnership, which is a different taxpayer than the two partners.
I'm sorry, okay. So above and beyond you guys, like I'm listening to this and saying LLC, oh my God, who do I talk to about this?
Okay.
I mean, an accountant's great, but would you recommend a tax attorney or real estate
I don't think
attorney?
you would need to get to the level of an attorney specializing in tax. I think most real estate attorneys are very familiar with that. So whatever attorney your client would be using to handle the closing, I believe would be.
Yeah, I guess I'm asking more like setting up the LLCs and figuring out like down the road I'm gonna sell this and you know, all of that type of thing. What would you recommend? I wouldn't think that would be the real estate attorney that handles the closing because that's all preliminary things, right?
Most do, and if not, an estate planning attorney will do business succession and, so if the real estate attorney doesn't, then an estate planning.
You know, real estate's trust. There's a lot of attorneys who cover multiple facets, so they'll do all that.
And establish your LLC and help you, but in this transaction, I think it's like them, a real estate attorney, and usually a CPA, but not like a tax attorney.
Yeah.
Unless they're in default.
One more type of partial exchange I want to touch on is if you sell property and either need to or want to take cash out on the sale, you can do that. Sell for $400,000, but you want to put 40 away. Maybe you owe some guy money or want to buy yourself a nice little present. You can do that, just knowing that that cash you take is taxable, and it wouldn't count as part of the exchange.
Can I ask a question about that?
Yes.
So can you pay yourself? So say you're buying a flip house and you want, so is that what you're saying if you wanted to expense paying yourself or anything like that? Or what about expenses for the flip? Do you deduct those?
That's a complicated question.
It is?
Do you mean the money you've put into this property before you sell it?
Right, before you sell it. So you're buying it at 300, you're putting 100,000 into it, you're gonna sell it for 500, you know, those expenses that you incurred to flip the house. I was just wondering if, would that all be considered, that wouldn't be considered the profit, it would just be the 100,000?
It would not be considered profit, right? Anything you put into it's part of your basis. So your basis would be your cost the any improvements made. That's your basis for gain or loss. But you brought up the issue of flippers, and actually a flipper doesn't qualify for a 1031 exchange.
Okay, well there you go.
Yeah.
All right. So because you're not holding the property
Exactly.
long enough?
Exactly. The rule is
How long?
well, there's some gray area there. Typically, if you are reporting rent on 1 to 2 tax returns, it would never be questioned, as your intent was to hold it for investment.
Okay,
But if you bought the property specifically to
to flip it.
rehab and sell, no intent to rent it out or hold it longer term, it would not qualify.
Okay, is there anything, do you know, is there anything that you can do to?
You can rent it out for a year
Okay.
after rehabbing it, and we see
Okay.
people take advantage of that.
Okay.
Another special case of property that doesn't qualify is property developers. So if you're a property developer, the property is not a capital gain asset, it's your inventory in the eyes of the IRS. So that gets its own treatment and does not qualify for 1031. I'll just run through the general process quickly. So our typical transaction, we always consult with people, freely ahead of time if they have any exchange questions. But we get much more involved once you're under contract. You have a signed purchase and sale on what you're selling. From that, we draft our exchange agreement, and leading up to the closing, we get in touch with the attorneys, like I mentioned. Then we close. The clock starts on the 45-day window to identify. If you need to make deposits on replacement property, we can use the funds we're holding, or we could reimburse you if you paid out of pocket. And if you reach day 45 of the exchange and it doesn't look like you're finding anything suitable that you want to pursue, you can elect not to identify. The exchange would fail. It would revert to a normal taxable sale, and we would return the client's money on day 46. Otherwise, if you do identify replacement property and you pass day 45, we have to hold the funds through day 180 or through the closing on replacement property. So that's one thing, to be aware of.
There's no penalty for entering into an exchange and failing. It would be the same tax treatment that you would have received had you not entered the exchange.
Can I ask a quick question? What if you go under contract on something, you just meet that 45-day period, but then you back out and you have to go, back out and find something else? How does that work?
If it's past day 45, if it's not something else listed,
so something that was already identified? Is that what you're saying?
yeah,
Even if it's through no fault of your own.
Right.
yeah. So it can be tough in that
So you
sense.
have to know that,
Yeah.
you want the, okay.
Oh, there
One
are,
more question.
yes.
If it does fail, who pays that? Do you submit the forms to pay those taxes before you return the funds, or does the client?
The client would at tax time, so we would return the funds and then it would be up to them to, no. They might make an estimated tax payment, when they know what they're facing at that point, but no.
So at that point, do you report something that you return that money? Is there
We don't. What happens is during that real estate transaction, they would have received the 1099-S from the closing attorney, and that, is the reporting. So if you're doing an exchange, then you file the form with your tax return that says, hey, I received this 1099-S, but here's what happened.
Okay.
And so if your exchange fails, then that 8824 form isn't filed, and that 1099-S.
So it's all determined
Yeah,
when you're filing your
Yeah, so we don't need to do any of that kind of outside reporting.
There's two complex types of exchanges that are important to know about, especially the reverse exchange. These are more prevalent in this hot market where people might get nervous identifying property in that 45-day window. The way a reverse exchange works is it allows you to purchase replacement property first, then carry out your sale within 180 days from the purchase and have it qualify as an exchange. It's a lot more complicated because there's a rule that you can't own both properties at the same time during an exchange. So this process that's blessed by IRS as of 2004 is, as intermediary, we create an entity that the client would loan money to make the purchase, and it holds the property until they make their sale, and then it's like they do a forward exchange with that company that we've created. So we create ABC company, client loans money to it, we purchase replacement property, eventually when they sell, they use those proceeds to buy the true property off of our entity, and that is a lot more complicated and more expensive for that reason, but in a lot of cases, it makes a lot of sense. If people have a significant tax obligation they don't want to roll the dice on, when it comes to their sale, they don't want to risk an exchange failing. The huge benefit to a reverse exchange is you don't have the pressure of the 45-day window. You do have to identify, but you're identifying what you're going to sell, which is a lot easier than identifying what you're going to buy.
Where does that financing come from?
That's another hurdle there. If you can't buy the property cash or, you know, arrange financing, it can be tricky because a lot of conventional lenders won't play ball on a reverse exchange because they're lending to a company we created a week ago that the true client has no underlying ownership interest in. So we've seen more cooperation out of smaller banks or credit unions that understand what's going on, but that can be a hurdle.
Because the client can guarantee that loan, but the loan would be made to our new company.
And they guarantee by utilizing the old property?
That can be also, yes.
It's gonna be paid off short term too, so.
Exactly.
Exactly.
So those are much more, well, we're seeing a lot more of them lately. Yes?
What are your fees and where do they factor in? Do you take them from the first sale, second sale?
Good question. Our fees for a typical forward exchange are $1,500, and we draw that right from the sales proceeds that are, you know, that we're escrowing, so that clients don't owe us anything out of pocket or upfront if, as we know in real estate, closings can be delayed for some reason or another, or fall through.
Or if they fall through, yeah.
Yeah, so we don't want people to.
Yeah, we don't ask to be paid if the sale falls through. It's only when and if you close on the sale, and then we pay our fee from that.
And if you're in the circumstance where you reach day 45 and don't ID and go forward, we refund $500 of our fee at that point. If you buy more than one replacement property, we charge an additional $500 per closing. And if you're doing a reverse exchange or construction exchange, which I'll explain in a minute, our fee for that is $5,500. A lot more going into the documentation and the creating the LLC and filing a tax return for it and all of that.
That is a flat fee. We don't bill back for the disbursements. As Joe said, you know, we do need to file a tax return for this entity we've created, which in Rhode Island it's $400. You know, the cost to establish the LLC is $150. We absorb all those costs, but it is a flat fee. So your client will know going in what they're going to be paying.
I apologize if this was already covered, but as far as what is retained at the sale, is it everything? Is it a percentage that is retained by you folks, or how does that work?
For a fee or of the sales proceeds?
The proceeds.
The proceeds, most of our clients will put all of the sales proceeds
So you take
in.
everything and then we'll
Yeah.
split it off.
Yeah, usually, yeah, there'll be a line item on the settlement statement of the amount that would otherwise have gone to the seller, going to the qualified intermediary, and the bottom line cash to seller will be zero.
Okay.
So it's fun, we go to a closing and you sell your property and I get all the money.
Are we doing on time? Are we okay? We'll just go through the construction exchange.
Yeah, so construction exchange, these come up when you want to make improvements to the replacement property and have it all qualify for the exchange. So if you sold for $500 and found property for $300, but want a, you know, new kitchen, bathroom, deck, that would bring it up to $500 for a full tax deferral, you can do what's called a construction exchange. You run into the same complexity of a reverse exchange because in this case, the rule that makes it tricky is you cannot use exchange money towards property you already own. So if that closing, you know, is on day 30 of the exchange, that's when, you know, they look to the value. Was the purchase price as high as your sales price? No, but since you're willing to do those improvements, we structure it in the same way. We create an entity, it parks the property for you, takes title, and you carry out improvements up until day 180 or until you've, you know, put as much money into it as brings the value up to get your full tax deferral. And then you buy the property as improved off of our entity. Those are tricky and also fun, but
the construction exchanges are tricky now because people can't get help, people can't get supplies, and you are limited to the 180 days from the date you sold. not from the date we acquire that property. So yeah, those are tricky.
Yeah.
Are there
Yes.
any- Just like a 203K, is there any rule as to has to be a general contractor or licensed or anything like that?
No.
So I can do the work myself?
You can do the work yourself.
Okay.
People can also combine reverse and constructions. Those are
Oh, boy.
extra fun. So for those, we create the company, it acquires in advance, you pump money into it, then on the tail end you sell something of yours. Don't do this.
This is when I start drawing pictures.
Yes. Here's another case. You can combine forward and reverse exchanges. So let's say you own 2 properties you want to sell, and the perfect replacement property, closing would happen to fall in between the 2 sales. What you can do is sell property A as a forward exchange, identify that replacement property, say sold for 500, buy for $1 million. You want to get that second sale in and qualify. When you acquire that $1 million replacement property, that can also start the clock on a reverse exchange with that same mutual replacement property. So you'd have 180 days on the other end to carry out sale of property B. Fun, right?
So what happens with that is the property that you're buying, you would be buying, let's just say half and half. You'd be buying half of it to satisfy your forward exchange. Then our new company we've created would be buying the other half to hold until you sell your other property. So.
All sorts of options.
Right.
So in other words, just have them call you.
Exactly. We had a client a year or 2 ago that made great use of the reverse exchanges. He owned property in a certain condo complex in Massachusetts, and he had a few single families, scattered around, and he ended up doing reverse purchases on 11 units in that condo complex, using 5 sales of his to, make it all match up, and wound up, selling for 1.5 million in total and buying for 1.5, and it was a lot of fun for all involved. But that was a great example of this guy. He said, I want all of my investments under one roof or in one area for convenience, and now he owns half the place.
Yeah, right.
So at the end of the exchange, we do provide a nice binder of the whole transaction that your client can present to their tax return preparer. And we have surprisingly few questions from CPAs, so I think
Because we do such a good
our
job.
binders are pretty good. But we outline, there's a summary where we outline the same questions, the same information that the IRS is asking for on the tax filing. So we do provide that at the end of the exchange period as well.
Any questions? So the most important thing, like I said, if you have someone selling something that's not their personal residence, ask what their plans are with the proceeds. Have they heard of a 1031? If they haven't, you got those brochures, you got contact info in there. Never hesitate to reach out with any questions that come up. We're always happy to talk consulting.
I'll sneak one more in.
Go ahead.
Getting back to, it's related to the last question I asked.
Okay.
So let's just say that, round numbers, the individual purchased that property for 200,000 10 years ago, whatever. And so their balance is down to 100,000, and they sell for 5, right? Would they be able to retain the difference in what they purchased and what is owed? Because I imagine that would not be taxable. Because that principal has been paid down.
Yeah, no, they
So it's
can't.
everything.
They have to reinvest the whole amount.
whole amount.
They can't recover their basis, right?
Okay.
That's a very common misconception, and, yeah. We did pass out, a 2-page, handout that does address questions we often see from real estate professionals. One of the important things with the purchase and sale agreements is they do have to be assignable, because part of the rules require that the purchase and sale agreement get assigned to us as qualified intermediary. But if you are using your standard Rhode Island Realtor agreement, those are assignable, so it's not generally an issue. Anything else?
Yes.
I just have a comment. Hi, Laura, Joe.
Hi.
I'm Bill Singh.
Oh, Bill.
I personally have done 2 exchanges with our 1031 exchanges. These guys are fabulous. I peppered them with questions sometimes 2 and 3 times a day, as well as my partner, Brian Joyner, and they handled everything magnificently.
Thank you so much.
We appreciate
Feel free to
that.
call them anytime.
I also vouch for them, they just helped me out on a sale with a client.
Thank you.
Thank you.
A month ago, actually.
Just
not
about,
long.
yeah.
They were great.
Thank you.
Yeah, we really pride ourselves on being accessible, responsive. The fact that we're not some attorney who does this on the side, we're one-trick pony, and it allows us to be that responsive. We get back to people remarkably, and
Right, we
they seem to
return
appreciate that, so we try to do things right.
Well, how long have you been doing this?
About 8 years now. Yeah. It's been fun.
The business has changed quite a bit, as has yours with COVID, because our main marketing when we first started out was attending closing. So we'd meet all the real estate professionals, we'd meet the real estate attorneys. Occasionally there'd be, bank professionals there, but once COVID came, we were not welcome anymore at the table. So we do so much now just through DocuSign and email.
Luckily, we had several years of
Yeah.
pounding the pavement
Right.
and getting out there, but
Right.
referrals are a huge
Okay.
source of our business,
Yeah.
and our relationships with realtors, attorneys, and CPAs really drives our business, and we like to be a great resource for them so that it's reflected back on their clients, and we see the positive ripple effects of that all the time. We love when people say, my realtor told me to use you, my lawyer told me to use you. We love those combos.
All right,
I think that's it.
awesome, thank you.
Thank you guys so much.
I made some notes based upon it, and I can't speak to the 1031 portion, but not directly to them, but on a lending standpoint, which I'm more familiar with, Ron's more familiar with, Lisa too as well. So, a construction exchange sounds like an excellent program, because you're not gonna do on a conventional, on a residential property specifically, you're not gonna get a rehab type situation. Fannie Freddie aren't gonna do it. There's some non-QMs that are out there that are available, but those programs are sort of iffy on the shot. So that construction sounds like it's gonna get carryover for you to be able to take those funds in order to invest in that property that may be deteriorated to some degree, as long as it's not financing directly into it. So you might be able to move that into that avenue. So it could help on those types of situations where the property could be run down. It sounds like it definitely is a push towards that. Because on a residential standpoint, if something's distressed and non-livable on an investment standpoint, not a lot of rehab available in order to do that. So this could play into that. I think that those individual lenders like you're talking about might play into that too as well, and realizing that the work's gonna be done to some degree. I wrote down a few notes specifically on that. I know that Carl brought up mixed-use properties too as well, which are generally residential in nature, but actually can have a commercial aspect to them. And there's certain rules and regulations on those too as well. The property has to be, that's not on an investment situation. Mixed-use users are gonna carry over for that, unless it's more commercial in nature and they're gonna buy it, and that's a commercial lending program. However, if it's a residential with the one unit, like the two, like we were discussing on a different project, one unit above, one unit below, that's residential specifically, and it's not a 1031 investment property at that point, so it wouldn't work in that avenue. And those have different sets of guidelines and rules, which usually require the whoever's gonna buy the building to live upstairs as a primary residence and then to occupy the business downstairs. And the business downstairs has to be less than 50% of the overall square footage space of the building. And there's also some pretty rules about income. The income has to be less than 20%. So that's a different avenue on that point. Now, in a commercial, you might have something on a commercial basis, which might have that, maybe a residential in there and multi-commercial spaces. That's a little bit different. So that'll run in that avenue. That'll be more of an investment to that degree. See what else I have on here. Mixed use, so they talked about that. 4 units and under. Obviously, anything 4 units and under is residential. Those programs are off there, 25% down generally. Anything over is 5 units commercial, specifically. Fannie and Freddie allow for only so many units that you can finance. So as you start going through, you get to 10 properties. The Fannie Mae's 10 properties overall, and then Freddie's 6 1 to 4 unit investment properties across the board. I think that's it for all that. So I want to thank both Joe and Barbara. That was fantastic and very educational. Thank you very much.
Thanks for having us.
Some housekeeping portions. This is there's a survey right there. I think it might be handed out to all of you too as well, to go through it if you have a chance. We also look for ideas for our next education meetings. We do have another one next week, which is going to speak to solar panels and what their effects on the sale of the property could be, how they can transfer over to your new owners, your existing owners, knowing that beforehand. We try to put on education meetings once a month. This is our November when we had to move it up because there's some work being done at the office overall. So we'll have another one in December, which is, what's the number? There's a number, what's the number? 37, thank you, 37 ways to lose your license. It's gonna be a two-part series. It's gonna be a two-part series, we're gonna break it up into 2 different sections, and it's going to be... It's not necessarily losing your license, that makes losing the classification. It's a little different to that avenue. The education committee is always looking for ideas, as I stated, or also members who want to participate. We meet on the second Tuesday of the month now, here at 10 o'clock in the morning. So anybody's welcome to come to that. And I thank you all for coming. I look forward to seeing you hopefully next week as well. Thank you again.